Ladies and gentlemen, Mario Galdos, your bald guy with the bow tie from the Triton Group at Legacy Mutual Mortgage, bringing you your tip of the week. From the office, we are back in action here in the office. Very excited to be back in my office. After about a year at the start of the pandemic, we decided, you know what, it's a good time to come back. Now, we're not doing in-person consultations yet, so we're still doing everything virtually, but we are getting there, and we're going to get set up so that we can actually start seeing some people here in person before too long. So we'll keep you posted on that. This week's tip of the week is focused on the FHFA announcement, which is the government-sponsored enterprise that is Fannie Mae and Freddie Mac, which are basically all conventional conforming loans, stating that they are wanting to limit the purchase of investment property and secondary residence homes to 7% of their portfolio. So statistically, they're purchasing about 9% a month into their portfolio, just organically. That's kind of the number that they have there. So they're wanting to take that number down from 9% to 7%, maybe basically promoting primary residence purchases. Now, what does this mean for investors or second home buyers? It means that it's not going to be as easy to get an investment property or second home loan, not because they're changing the guidelines, but because it's going to limit the amount of lenders out there who are willing to actually fund these loans, because they're not going to be able to sell them back to Fannie Mae or Freddie Mac, who is the ones who actually sponsor and support the mortgages once they're sold off the lender's warehouse lines. So how does this translate into anything for investors and second home buyers? It means that lenders are going to have to slow down the drip by either increasing down payment amounts. So statistically, the minimum down payment for an investment property is 15%. However, most folks put 20% down because at 15%, you're still going to need mortgage insurance. At 20%, the mortgage insurance drops off. Some companies are going to go up to requiring 25% down just so they can limit some of the investors that are looking to purchase those investment homes. Same thing is looking like for second homeowners. Right now, the minimum requirement investment is 10% down. That is looking to possibly increase as well, but this is going to be lender by lender on a case-by-case basis. The other way to also slow down that drip that I'm mentioning is by increasing interest rates. So as you increase those interest rates, again, some folks who are not really maybe the necessarily investors are going to kind of shy away from saying, hey, you know what, let's maybe not purchase. Maybe this isn't the right time to purchase an investment property. However, I look at it always like, hey, if you're a real investor that's, just looking to acquire properties that are going to cash flow and earn you some extra income, the interest rate's not really going to matter. I mean, we've seen interest rates for investment properties in the 3s. Even if they go up to the 4s or the 5s, that's still not going to be a bad deal, especially if the deal makes sense or the investment makes sense and is cash flowing you some money. So either way, what we're looking towards here the next week is going to see some more responses to how the reaction of the market is going to be, and to other lenders in the marketplace for this announcement. So if you have any other questions about this, I know it's we're kind of hanging on a thread here right now, trying to figure out what it's going to actually look like in the coming weeks, but we're going to keep you posted, so stay tuned. Give us a call if you have any questions, 210-476-5523, which is the office number, or send us an email at tritongroup@legacymutual.com, or visit us online at tritongrouphomeloans.com. Have a great weekend and stay tuned.